Okay, everyone. Hello, and welcome to a joint webinar from MCT and TMS on successfully growing into a mortgage banker. Regardless of if you're a broker looking to become a banker, a non-delegated lender looking to become fully delegated, or a small delegated lender looking to grow, both TMS and MCT have helped many through those very processes. And our presenters are going to extend some of their experience and knowledge to you today. We'll have a short question and answer session at the end of the presentation, and we'll be sharing the recording and slide deck via email after the conclusion of the webinar. Today's three presenters are Danielle Shipley of MCT, who is joined by the Money Source's Tom Gillis and Brett Taylor. All three bring decades of experience in the mortgage industry to today's presentation. On today's webinar, we're going to talk about the benefits of becoming a mortgage banker, some myths associated with delegated lending, a checklist for making the transition, and then, as I said, a question and answer session at the end. So without further ado, I'm going to pass it to Tom Gillis.
Hey, good afternoon, guys. So when we look at this, growing old is mandatory, but growing up is optional. Some mortgage companies don't have plans for growth and are content with their production and profits as they are today. This webinar is for those brokers and non-del lenders who want to grow and evolve their companies with the ultimate goal of becoming a delegated lender. So 2 weeks ago, I was in Utah meeting with some business partners, and I met with the CFO of one of our clients. And he shared with me his net worth at the beginning of 2020 was $6 million. But by the end of 2020, his net worth ballooned to over $16 million. His net worth today is over $20 million. And this company is funding around $70 million a month, so by no means are they a mortgage giant. So in 1 year, he grew his company net worth by $10 million. Now let me ask you, how many brokers and non-del lenders do you know that grew their net worth by $10 million last year? And years like 2020, when there is a capacity shortage, delegated lenders can average up to an additional 100 to 200 basis points per loan. Now, obviously, in a competitive market like today, those margins that spread between non-del and del have shrunk dramatically. So as a delegated lender, you control your margin management strategy. As a broker or non-del lender, as the market size increases, your non-del investor and TPO lender increase margins to maximize profits and optimize capacity. You do the same as a non-del lender. As you build up enough critical mass of like product, you have the option to consider hedging to further boost your returns. Also, many of our clients now retain servicing on a portion of their production. What this enables them to do is create a steady monthly flow of servicing income coming in that can act as a hedge when production profits decrease. Additionally, delegated lenders can charge underwriting and processing fees. Another important factor is you have more autonomy as a delegated lender. Bankers don't have to disclose what they make on each loan. All originators are regulated by the Dodd-Frank LO compensation rules. However, mortgage bankers determine their own margins and profitability depending on market size, competition, and capacity. Now, if you're a broker, you're capped at 275 bps and the comp plan set with your wholesale lender. Mortgage bankers don't have to disclose their profit or gain on sale because there is no gain until the loan is closed and sold to the correspondent investor. And furthermore, you decide which loans you want to broker and bank on a loan-by-loan basis, and you're deciding if you're going to go non-del or delegated if you're banking. So in June, I moved my family from Los Angeles to Denver. We started looking for houses. We found a great house that we loved. We put an offer in to close in 25 days. Now, we didn't get that property because the seller selected an offer from someone who was closing in 21 days. In this ultra-competitive purchase market we're in, closing a few days sooner is everything. As a delegated lender, you can optimize which loans you're going to underwrite in-house. For example, you can choose to underwrite all of your purchase loans and loans from important referral partners in-house, and then choose non-del or broker for your refinances. Ultimately, you want your goal to be to underwrite all the loans that are liquid in-house and utilize broker or non-del for more niche loan programs. As a delegated lender, you have control. You can move any condition prior to funding, and it's your decision when to send docs out. Now, who wants to know when docs are coming out? Realtors do. Most of your borrower satisfaction is built upon the expectation you set with your borrower from the onset of the transaction. As a delegated lender, you have more control and can set expectations accordingly. So what better way to help branding than closing loans in your own name? Closing loans in your own name also helps create a connection and confidence with your borrower that will help you win their next loan. Now, a way to build confidence with your originators is by building your internal guideline box. Instead of just relying on your TPO lenders guidelines, you have more control over your credit box since you're establishing your own guidelines. Most of our clients establish minimum guidelines that apply to all of their investors. Now, during COVID, how many of you on this call had one loan that you had to move from lender to lender to lender? As a delegated lender, you aren't delivering loans to your investor until after the loan is closed. Now, the fastest way to grow your business is by recruiting producing loan officers. As a broker, you have a contractor relationship. Delegated lenders generally recruit LOs that become employees of your company. So what this means to you is you're able to attract top talent and recruit them because you can offer benefits like healthcare and 401k. Another great way to build your business is through referral partners. Realtors, home builders, CPAs, financial advisors all prefer to refer clients to loan officers of delegated lenders because they know they can control the they can control the process, and they have a better chance of delivering a great borrower experience. So we talked about how being a delegated lender can help increase your production and profits today. But what about the future? How many of you have considered what your exit plan is for your company one day when you want to retire? Delegated lenders create a business that generates income that can be monetized for sale at a later date. You're investing time and money today to help create future security tomorrow. Now, when delegated lenders sell their company, that sale price is typically based upon a few things. The first one is a multiple of your earnings. Secondly, any mortgage servicing rights you have. And third, any other fixed assets. Now, you routinely see private equity, hedge fund, and other startup mortgage company purchase small delegated lenders. But why? The reason is they will purchase them just for their agency approvals. Because if they were to start the process, there's great value for them in being able to have those approvals out of the gate. So in fact, if you have your Fannie, Freddie, and Ginnie approval, you can run a business that generates almost no profit and you will have a buyer for your company that's willing to pay you millions for your company. So in conclusion, if you're ready to put in the work, you want to make more money over time, you want more autonomy, you want more control, and you want to grow the enterprise value of your company, then I hope I've showed you why becoming a delegated lender would be a great option for you. Now I'm going to hand it over to Brett Taylor to talk about the myths associated with delegated lending. Thank you.
Hi everybody, Brett Taylor with TMS in our capital markets group. So Tom spoke a lot about the potential benefits, which there are many, moving into a delegated mortgage banking organization. And we talk to a lot of lenders and we hear concerns about that transition. I want to talk about some of the myths and shed some light on what that actually looks like. So when you look at our first myth here, it's I need to be big to be my own delegated lender. Well, all successful companies have to start somewhere. We see delegated lenders as small as a few $1 million a month. And really, you just have to know your goals and be realistic about where you want to aspire to. It's okay to start small and utilize third-party companies and to transition and for the heavy lifting, right? And that kind of is a perfect transition into the myth two, which is I need a ton of operations people, underwriters, funders, secondary people, lock desk managers. Well, when I speak with clients, the narrative has changed. It's not about just hiring more. It's about leveraging vendors to reach those economies of scale and to grow your business in a thoughtful way. So people on this call, your MCTs, your TMSs, we can help make introductions to outsourcing companies that have the necessary capacity for you to grow. It doesn't have to just be on you. I mean, a perfect example is, maybe you think I need to hire, I don't have the budget to hire a big ticket secondary marketing manager. Well, MCT, for example, they can actually help you train someone internally who wants to take that next step and also help you develop lock policies. And TMS has many contacts with various third parties that can help you assist you in some of these outsourcing needs. So there are things that can be leveraged to help you in the transition. On myth three, you have, I need to spend a fortune on technology to become a banker. Well, I'd be lying to you if I said that in today's environment, technology wasn't important. It's paramount. Having good technology and data is part of what makes companies successful and can differentiate them. But the big ones we hear about are, a new pricing engine or an LOS. There are streamlined and affordable options out there that can still meet your needs as a mortgage banker. So it's important to grow into new technology, but there are options besides just the main 2 or 3 you might have heard of that can still meet your needs and allow you to grow. And we can help get you to the right vendors. On the next slide, we talk about I need a lot of net worth. So really this one and the warehouse line on myth 5, they're kind of tied together. It's not always true that you need a lot of cash. I mean, true large investors can require high net worth. But with the right investors, we've seen clients make the move into mortgage banking with as little as $500,000 in net worth. And there are many investors who are willing to work with these transitional accounts. I mean, TMS, for example, we specialize in working with growing mortgage bankers, and we really feel that we have the tools and the expertise to kind of foster that growth and work in a strong partnership. And remember, our goals are mutually aligned. Your investors and the vendors you work with, they want you to succeed. It's a positive thing for both parties if you originate more compliant, well-manufactured loans. So keep that in mind that there is support to help you through that growth process. And so on myth 5, as I said, it's directly linked. I won't be able to get a warehouse line. Not everyone's eligible for a warehouse line, but there are warehouse companies that can specialize in transitional lenders just like some investors do. And you tend to see that there are relationships developed between those companies because they have to work together more closely. We can help make those introductions to warehouse banks that can make that transition easier and more logical for you and hopefully less stressful. It's about pairing the right company to the right warehouse line or investor or vendor. On the next slide here, we talk about, do you have to choose between going fully delegated or non-delegated? Well, Tom did a good job of covering this. And just to reiterate, developing delegated lending doesn't mean you have to do all your loans that way. You can enter the delegated space in a thoughtful and controlled manner. You can send certain products or risk attributes non-delegated until you get your feet under you and you start to feel more comfortable. I mean, we see this all the time in established mandatory hedge shops. We see this all the time where they'll send their vanilla product that they're very comfortable with into the mandatory space and they'll put in their hedge. And then they will put other loan products, they will commit them via best effort method. So you can see the same strategy being used by fairly sophisticated accounts. You can see it applied into the delegated, non-delegated space as well. And really, while we're talking about those options to mitigate risk, we should talk about the big one, right? The elephant in the room. Delegated mortgage banking is risky. Well, let's draw an important distinction to start with. First off, there's your wholesale accounts looking to make a transition, and then there's your non-delegated accounts looking to make the transition into delegated lending. Well, your non-delegated bankers, you might already share many of the same contractual risks as the delegated banker does. And frankly, you might be giving up control today over your origination process for minimal protections down the road. I mean, as Tom said, there's a lot to be gained through the control you have and the ability to own the process through closing of the loan, and you might be giving that up. So read your contracts and really know what you're getting into. In terms of shops making the transition from wholesale, well, you might be incurring some additional exposure, but you just gain so much in the transaction. As Tom said, you have more control over your process. You get full monetary rewards, right? Especially in years like 2020. You get more autonomy. All of these things add up that can build your enterprise value, that can build your, your ability to manage relationships and grow your business. So, and just for the last part in terms of the risk part, you're not doing this alone. There are third-party firms, investors that you can build relationships with, and they can help you build strong controls to manage and mitigate your risk. So just know that you have those options out there, and you can grow into this mortgage banking world in a thoughtful and controlled manner. And I guess while we're talking about perception of risk in delegated banking, I'll spend some time on my next slide to discuss hedging and your mandatory executions. So established bankers have the opportunity to hedge their pipeline and execute post-funding. So what does that mean? It means a mortgage banker has the ability to take the commitment, a lock with the borrower, put it in their hedge, and then own the process entirely until the loan is funded, and then take a commitment out with an end investor. So that hopefully gives you more options in terms of your execution at that time, and allows you to fully own the process and not be subject to your end investors' commitment policies necessarily, since you own the loan until it's closed. So will you be hedging on day one that you transition to delegated banking? Probably not. I don't think that would be prudent. But it's a logical transition point if that's where your long-term vision and goal is. So when you're a delegated banker, you have to fully own your process. And so a lot of what creates success in hedging is ownership of your pipeline. It's about creating consistent and predictable processes that you can hedge against. And so when you enter that mortgage banking space, it allows you to kind of hone your craft and fine-tune your internal processes to put yourself in a position to start hedging down the road. And then when you're ready, you have third-party firms like an MCT on this call that can provide you with reporting and assistance to set up your processes so you have an effective hedge strategy in place. And so all of these things are just pieces in a puzzle that add up to something, to a successful, well-run, large mortgage company. So when you can set up a hedge, it's kind of success breeds success. Transition to banking gives you controls, gives you more control, which allows you to hedge down the road, which can then in turn give you more control over your process back in the terms of your own lock policies and pipeline management tactics. So these things can build on each other. This is obviously a long-term goal, but just see it as stepping stones to that more sophisticated execution and hopefully more profits and enterprise value for you. With that, I'll send it over to Danielle.
Hi, everyone. All right, so let me get that perfectly. All right, so we're going to go through a checklist right now on what you need to consider in making that transition. We're going to look at staffing. We are going to look at technology, centralizing your lock desk, compliance, policies and procedures, warehouse investor approval, and net worth. And I have a really fun tip for you guys at the end that typically when I bring it up to companies that are probably in the position you're in, they don't realize that they can increase their net worth potentially without even adding any money to their company. So we'll go through that at the end, and we'll open for questions. Robbie, can you flip to the next screen for me? All right, so like we were hinting at it in the beginning of the call with Brett and Tom, keep an open mind on outsourcing. I think that we're seeing a trend just generally in the marketplace where it's working, and it definitely seems to be working for companies that are in this transitional place. We know that the conventional can be easily outsourced from an underwriting perspective, not so much with the government, right? But keep your eye, I put this as an insider tip because this is huge, guys. Keep your eye on that government. As you outsource your conventional production, or maybe you bring someone in-house, keep working on getting that government in-house. There is wider spreads there. You're definitely one day going to probably want to hedge that product if you get enough volume to do that. But outsourcing can provide you an opportunity for this transition. We're seeing it really gain a lot of success. You can integrate some level of outsourcing. It doesn't have to be with your underwriting. It can be post-closing. There's operational outsourcing. So there's different levels of your organization. Even accounting. Accounting is so overlooked as far as outsourcing potential, but you can outsource a lot of those widgets that can be duplicated. It can really save you money where you can have your internal employees really focusing on that bigger strategy, and we're going to talk more about that a little bit later. So maybe you're not comfortable with outsourcing underwriting. Okay, we had a client here in San Diego, and this has been duplicated across the country, but we had a client that decided to utilize an outsourcing firm for pre-underwrite purposes. And so what they did was they said, you know, they were already delegated, but you wouldn't have to be. But what they did is they offshored that. So the loan officer takes the application, gathers everything up. They send it in for this pre-underwrite, and overnight it comes back with essentially an underwritten review that's stiff, but it's not officially underwritten, right? But then you have, what ends up happening is you've got this complete package that's being delivered to your underwriters. So your underwriters they're happier, right? Their job's easier. They're not having to chase down obvious, what they would see as being obvious things inside of the file. So they're getting really clean. They can really focus their time on those more difficult files and just get the files through faster. So while the loan officer is sleeping overnight offshore, their whole file is getting essentially stiffed. So the one client that we talked to, and we've heard it duplicated several times over the country, but the one that really struck me said that they were able to shave about a week off of their turn time. And like Tom was talking about in the beginning, we all know time is money in our business. It absolutely, but it can really make a difference on whether you're getting those realtor relationships, in the door and able to keep them. So that's important. And that was a really great tip. All right, so when you're thinking about staffing and making this decision, you want to start really getting clear on divisions of labor. If you're watching this and you own your company, you might be the one actually locking loans. Probably not the best use of your time, but it's where your money is being held. So you want to understand and control that and make sure there's no errors, right? We get that. That's very common. As you grow, though, you've got a lot of different staff that might be wearing many different hats. So you want to start separating that division of labor. That's really going to help you control your risk and mitigate it. which is what we're really focused on here. LO comp plan, right? This is you've got to be so careful and clear and compliant with your LO compensation plans. Lots of resources out there on how you can get creative on that. There's tools that can help you effectively track it and manage it that are available in the marketplace. So I would certainly explore getting creative with the way you're comping your LOs, but in a compliant way. Maybe leverage of technology to help you do that. Clarifying all staff roles and responsibilities in writing. Everyone really needs to know what their contribution is and what their responsibilities are. Policies and procedures. I know a lot of people on this call, they might not have policies and procedures. You're not alone. A lot of clients that even we transitioned to mandatory that have been delegated, successfully delegated for years, don't have them. But I can tell you for sure, it's introducing risk if you don't. You really, or they might have them enough to check a box for an auditor, but it's risky because they're not really, it's not a living document. You want your policies and procedures to be clear, to be understood by your staff, relevant, updated. Have someone in your company actually own them and put their name on them. Maybe you have regular meetings to evaluate how relevant they are in your company, but the policies and procedures are huge. We can certainly help you on the secondary side. We'll talk more about how we could support you on the lock desk side. Happy to share tips and trade and what you could do to get those buttoned up. And then there's firms out there that can support that as well. So if we can go to the next slide, I really want to get into this. All right, so you're going to have a lot more control, guys. So you want to fully leverage that increased control. Like Tom and Brett were talking about earlier, your service level should increase because of that improved control. You should be able to control those approval timeframes. And what we see really successful companies do is adapt the company growth plan from all divisions. And this can be true both in your transition into delegation, but also into your transition to mandatory. Sometimes we get afraid that, I know that loan officers and account executives oftentimes feel that secondary is hiding, maybe could be hiding revenue or not being forthright on the profit. It's interesting because more often than not, I would say in most all cases, it's really not the case. Everyone is really looking for how can we make this a more profitable company. People are constantly juggling, trying to bring their margins in or out to be competitive. And I think that when you're looking at the growth plan, letting everyone know, if you do go to mandatory, announce it to the company, get their buy-in. If you're moving to delegation, let them know how that's going to benefit their relationships. And keeping that vision open and transparent, it works. And I think that works in the very best way. So yeah, empowering your employees. We talked about this, recruiting advantages. I mean, it's huge. Seasoned talent, they want to know you can control it in-house. They just do. And the relationships that they bring are going to want to know that too. And you never know who's going to come with experience that can elevate your company. So that always can come with a more mature environment for them to work in. All right, KPIs. When you move to delegated, and it's something that we see, it's probably 50-50, where clients, they don't really look at this as much as they should. Once they move over to the mandatory side, we've got all kinds of tools for them to monitor that. But as you're making this transition to delegated, can you assign those key performance indicators? Can you assign that to someone within your company? Data is everything. That's why we put data. Look at the profitability trends by loan, product, investor turn times, underwriter, processing touches. All of those things, if we can measure them, then we can improve them. And so that's part of getting your company on board with this vision. Hey, we're elevating, we're taking our company to the next level. I need your help. So here's where we are. Where are we going to be in 6 months? Where are we going to be each quarter? And remember, slow is fast. So as you make any transition, if you move too fast, and we see that too, clients stumble over. So I have clients that come to me and say, hey, we're getting delegated. We want to go to mandatory. and I know that they're going to get there. You can tell when you talk to people who you kind of get a sense for it. You're like, these guys are going to make it, and you believe in them. But you kind of have to encourage people to slow down a little bit. Like Brett and Tom were saying earlier, you don't have to put everything in. You don't have to dive in head first. Take a little piece of it. Maybe have some hybrid outsourcing. Grow thoughtfully, right? So just it's really something to consider, because slow really is the faster way. Let's go to the next slide and see what we have. Okay, technology. Technology is so important. Okay, insider tip, right? He who has the cleanest data makes the most money. This is true amongst, we have hundreds and hundreds of clients. MCT has advised more clients in moving to the mandatory space than any other hedge advisory firm in the country, I think it's safe to say. And throughout all of our operations, the clients that make the most money, they have clean data. They can manage leakage. They can really focus on those key performance indexes so that they can improve them. So sometimes we'll see in the transitional place that you think you're cutting costs. You're like, well, where should I invest money? You really need to invest in yourself, your company, your growth. And the most successful people know that. You probably know that. That's why you're on this call. So this patched together setup and legacy broker systems, they're not going to work. I mean, in the short term, you can kind of bubble gum and Band-Aid and get by, but I would recommend, and we would all on this call strongly recommend, that you get an LOS and definitely a pricing engine prior to this conversion or in concert with the conversion. You just need it. You need it for the longevity of your company. You need it for risk mitigation. The pricing engine is one that I'll see overlooked sometimes when clients move to delegated. And we're going to talk a little bit more about this, but you don't want your LOs locking loans. They want to originate. They shouldn't be doing that. And for so many reasons in setting you up to continue to grow into where you want to be, that's not a scalable model. So this patched together technology, we talked about, it introduces risk. It slows you down. So in the beginning, that's where we're talking about getting ahead of yourself. So in the beginning, you might feel like, oh, I'll deal with that later, and let's just get to delegated. We've got wider spreads here available. And then you build something, and then you've got to go back and fix it. You always have to build from the ground up. So just do it now. Do it now. You'll thank yourself later. Just slow down, build it right, and we'll be there cheering you on. When you have patched together technology, it really does hurt your corporate culture. You might not completely see it. We see it a lot because we're kind of the gatekeepers of everyone's secrets at our company, because we hear from the capital markets and lockdown staff, how they're really feeling, and we're trying to work with them to improve their life experience, right? We want them to be as knowledgeable as they can possibly be, and as educated as they want to be. I mean, as far as they want to go down that rabbit hole, we want to be there with them. But we're hearing from them, and it's so frustrating when you can't do your job. When no matter how dedicated you are to managing leakage, you can't see it. So you need to empower your employees to do what you hired them to do, to manage the leakage, to help you increase revenue so you can pass it on to your borrowers, so that you can properly compensate your employees and keep them happy. So all the way around, I would just encourage that quite a bit. So it's just all about technology. There's different technologies out there. We can talk more about that. But make that investment. And like Brett was saying, you don't have to always spend the money that you think you need to spend. There's lots of transitional options that can help you grow, but you do need adequate technology there. So that's a big one. All right, let's move along here. So, okay, centralized lock desk. This is near and dear to our heart. So what were we talking about? Well, we're talking about you've got a pricing engine, and all of your lock requests are all coming into a centralized desk that is managed by that one person or that one team on your desk. So you might say, well, I'm not really ready to have a secondary marketing manager. I don't have the budget to hire someone. Consider elevating someone internally. If you're interested in having us help you do that, we do it all the time for companies. If you can get us somebody that has the aptitude, the desire to learn, and that wants to grow their career, we can absolutely make them a great secondary or lock desk asset. When you're looking to centralize, there's a lot of pieces that you want to consider. Chris Anderson over here is our Chief Administrative Officer, and anyone that's had the pleasure of meeting him knows that he's so great to work with, and he has built the largest outsourced lock desk, we like to say, in the universe. But anyway, and so we do help clients where we have the capacity to do that. We do help clients centralize their desk. We help them to build out policies and procedures and an actual manual that shows step by step what we would do or what they would do. Companies can outsource, and there's other options out there too in the marketplace, but companies can outsource all of their lock desk ultimately, soup to nuts, right? We would call that full service, or they can outsource just a piece of their lock desk, maybe just the initial locks only, that time-sensitive piece. So we would say build it yourself. You could have an introductory call with us, and we could tell you what we would be thinking about and how we would build it, and then you can run with that information. That's not something that we would charge for. And then, or you could say, hey, MCT, I'd like to say, include all the best practices that you've seen with all the hundreds and hundreds of clients that you've seen come through. And there's a lot of wisdom there that we've been able to glean on all the different pricing engine and LOS setups that can be really helpful. And so just you have access to that. So you could have us build it. You could build it. You could do a hybrid. Oftentimes, what works really well is if Chris's team can come in and completely centralize, create policies and procedures and manuals, be full service for some amount of time, and then kind of back off and let you guys take more of it in-house. So that works really well. We just want to see you be successful, really, with the lock desk. Our core business is going to be hedging. So, but why would you establish? Why would you centralize? So corporate controls are a big one. So that's just managing your compliance risk. You want to ensure that your pricing is accurate. Okay, and then you want to protect the corporate revenue. You need someone specifically to watch that and think about that. Data integrity is huge. We talked about that. And then with the regulatory compliance, so as you grow as a company, you're going to start needing to think about preparing your audited financials. You're thinking about the various audits that you come across, and there's going to become a need for that activity log, the history of price changes, pricing, exception approval documentation. All of that really becomes really very, very important for your business, and you need to manage that through your LOS and pricing engine. It's a requirement for mandatory. So if you're really planning on going all the way with your business and really growing, then ultimately you're going to have to centralize. But certainly we would recommend centralizing even if you never had a plan to trade mandatory. All right, let's move along here. Compliance, everyone's favorite topic, yeah. All right, so there's some obvious ones like NMLS registration, exploring the states you want to do business in. There's maybe some less obvious ones. We would say seeking legal counsel on. There's great consulting firms out there that can help you just package this up so nicely. So we have legal counsel. Okay, cyber insurance is huge. We've got NPI data, right? We're dealing with it all the time. We've got data breaches, rogue employees. This can really just jeopardize everything that you've built. So you've really got to protect your empire there. A fidelity bond is going to protect you against fraudulent and dishonest employees. Unfortunately, that's something that you definitely need. Your E&O liability insurance, negligent acts, mistakes, right? Protection there. D&O insurance, director and officers, protecting your officers and being able to elevate their titles without making them liable for lawsuits against them because of their titles. Your MLPA's contract review, that's helpful. You have companies that can help you do that. Policy and procedure, we can't say it enough. Adopt them, understand them, review them regularly for your ultimate audit preparation. All right, let's go to the next one. So it seems like a lot. I promise it's not. Just take it in chunks. We've got lots of context that can help you do that. So on the warehouse and investor approvals, all right, so I know so many of you on the call, you're thinking long-term. So you're thinking in phases. You're like, okay, I'm going to go delegated, and then, but here's my ultimate goal. Maybe it's, maybe it's a little further along than delegation. Really, for liquidity, business survival, we saw this. Everyone was around probably during the financial crisis, right? You don't want to have less than 2 warehouse lines. You just really don't. There's a lot of reasons for that may be obvious. One you might not think of is product insulation. So as product becomes illiquid in the market, your warehouse lenders can say, hey, we don't want to fund that product anymore. We're not taking this FICO band for a short period of time. So as you're exploring your warehouse providers, understand what investors they're willing to fund on their lines, understand what products they're willing to do, and maybe look into how those have changed during the crisis and during COVID, and how they pulled back. A lot of them did. You can't blame them for doing that. But if you understand that, then you can really prepare and spread out that risk by having various warehouse lenders. And they're going to need to approve your investor takeouts, but they'll be familiar with the investors probably that you'll be working with that we would recommend. So look at the financial stability of your counterparts, their reputation, and your ability to scale with them. There are broker to banker conversion warehouse lenders that we would recommend that can stay with you for a really long time. You're going to probably need to add some bigger lines later, but you can keep a lot of those relationships. So inquire about your goals and your ability to scale with them. Time invested in relationships, and we always say this all the time, this is a relationship business. We know that. Although it might not always be about price when it comes to your investors. You might have investors that have a product that they're really, really strong in, and another that, maybe you do more conventional business and they're not as strong as conventional. And so, but they have a lot of loyalty, a lot of expertise. Lean on them. You're going to grow. Just think about the long-term relationship. You can really diversify your investor set and your relationships that way, and feed those that are helping you out. Sometimes it's not about price. Sometimes you really want to think about the relationship. And here we're saying move to delegation because you'll make more money, but it's really something to think about. I think the strongest secondary marketing professionals at the largest shops, they realize that sometimes they'll provide trades to broker-dealers or to investors that maybe they're not always the best price. And there's a relationship play there, and it pays off. It pays dividends. So always consider that, value your relationships, protect them, honor them. And when you're looking for new investors or warehouse providers, think about, can they grow with you long-term, or is it going to be kind of a Band-Aid relationship? So you want those more long-term relationships. You're going to move to generic docs. You're going to start funding in your name. Here's a little tip. Get in the habit of including all the required docs that you would need from all the investors that you have. If for whatever reason you target a certain investor and that investor, you find out or they find out they're not buying that loan and you need to retarget it, you want to be able to not have to go back to the borrower. And ultimately, when you move to mandatory, if that's a goal for you, you're ultimately going to need to have your closing department comfortable, and you're sending out docs in everyone's name so that you can choose your investor then at funding at a later date. And we can talk more about that. All right, let's move along here. I want to make sure we get to questions. Oh, okay, so this is the one that I was really excited to share with you guys. On the net worth, there's really good news. So you can increase your net worth by adopting a standard in accounting called fair value accounting. Now, we would have what we see oftentimes, clients, when they're moving from broker to banker, they have legacy accounting firms that have been great for their business. When you start growing in and becoming a larger lender, it is so important. I cannot even stress this enough. It is so important that you find, and there's a handful of them out there that we would recommend and strongly support, that are mortgage-centric, industry-accepted CPAs. This is going to make your audit go easier. You will make more money. You will protect the company that you've built. It is really, really important to be with a CPA firm that understands mortgage. I oftentimes spend my time on, it usually happens once or twice a month, with CPA firms that I'm explaining mortgage to them. Happy to do it. You don't want your CPA firm learning about mortgage from one of your vendor partners, just generally. I mean, you want them to be an expert, and you want us working together to elevate with you, right? Getting your financials in a form that can be elevated. Okay, so what's fair value accounting? So I don't want to get too far into it, but I want to say this. You can start booking a value, and really, if you talk to the mortgage-centric CPA firms out there, they are of the opinion that it's best practice to be in a fair value accounting method, even if you're not a mandatory seller. Now, if you're delivering mandatory, this is a transition that you have to make because you have this derivative asset piece that comes into play. But not to get too caught up in the details on that. Your open pipeline, so everything that you have locked to your borrower that's in process, it can be, you just locked it today, it could be with the processor, it can be approved. Everything in your pipeline that's locked with your borrower, you can put a value on that and book a value on that every month. You can take 100% of the market value, which should be the value that you have it locked out with your investor. So if it's a 104, it'd be a 104 over par. Then you would pull through, adjust that value, the dollar amount of that value, and then you would back out any costs. We can certainly talk more about that, but you can do that on your open pipeline, and then you can also do it on the funded loans that haven't been yet purchased. But on the funded loans, you don't have to back out costs. It's 100% closed. So again, not to get too wrapped up in the details, but this can give you that significant lift to your net worth that you may need. And you're thinking, do I want to put more money in the company? Or maybe you don't have that extra cash to throw into the company right now. It might be tied up in other investments. Whatever position you're in, you don't have to. And this is something you're going to probably want to do anyway. So we can certainly get you in touch with a great CPA firm that can help you do this, and it's worth it, guys. It's really worth it, and it's a nice lift. All right, so I think that is okay. So that wraps up my section here. I just want to say that we are so incredibly delighted that you've joined us today. We're proud of you for being here. We hope that this webinar has inspired you to go after it. You're probably a lot closer than you think. Hopefully, we've demystified some of those myths, and you can grab that control, revenue, and efficiency that's really available to you. And understand you're not alone. Everyone on this call, there's so many partners that we have also extended from this call as well, both within our companies and out of our companies, that want to see you grow. We're all cheering you on. Between our two firms, we have all the contacts that you could possibly need. So we would love to hear from you. We would love to spend time with you and see what we can do together. So thank you, and with that, we'll open for some questions. If anybody has any, or if they've posted.
Awesome, thanks Danielle. Thanks for that overview, and thanks everyone for the great job presenting today. We do have a couple questions for the organizers. If you look in your panel and you look at the drop down under the questions section, that's where you'll find them. Danielle, if you know where those are, then you can go ahead and lead this portion. Otherwise, the first question is, can you give some examples of outsourcing companies for underwriting or processing?
Yeah, we certainly can. So I think it depends. I think it depends a little bit more in learning about how you want to scale, exactly what your timeframes are. It would probably be better if we took individual recommendations offline. There's a handful, but we can match your culture, personality, and really there's consulting firms out there that have a narrowed focus and a wider focus. So you can get more bang for your buck by working with, so let's say you needed consulting in a couple different places. We might target you in one direction. If you were just specifically looking for that, we might target you in another direction. So we'll definitely give you some people to talk to. Just follow up with us after the call, and we'll make sure we make those introductions, yeah. Unless you have anything to add to that, Brett.
You said exactly what I was going to say. We want a custom approach. It's not cookie cutter with some of these referrals.
Yeah, you really do. You really do.
It looks like there's a couple questions in here as well. Just can you elaborate on what you mean by mandatory?
Sure. Do you want to take that, Brett, or would you like me to?
I can take it. When we talk about mandatory execution, so when you are a delegated banker and you first start, you're most likely doing best effort. And so best effort means you commit it to your investor and you make your best effort to close that loan. If it closes, you deliver it to the investor. The investor bakes in the cost of hedging that because your investor is actually hedging it when you take out the lock. So when you have a borrower that you take a lock with, that's when you lock with your investor. They hedge it for you. When you move to a mandatory execution, you take a lock with your borrower, and then you actually place a hedge for your company. Maybe you use a third-party vendor, a trading firm, maybe you do it yourself, but you essentially place a hedge that will hedge the value of that asset while you're going through the origination process. And then when the loan is closed, you would commit it mandatory to your end investors, and you would lift your hedge at that point. When it's mandatory, that means on a VE, the investor built in a hedge cost. When it's mandatory, they don't build that in. You get better pricing because they're not hedging it, but they also assume the loan is closed. It's a 100% chance I'm going to buy that loan. So if that loan isn't purchased by the investor, you'd be subject to some kind of a pair-off cost, and that's what we're talking about.
Mm-hmm. No, that's perfectly said. So a lot of times companies will say, well, what's the benefit? What's the, how much money am I going to make? There's plenty of clients out there, they might even be on this call, or that you would talk to. Pretty much if you throw a stone in every direction, you'll probably find someone that does business with the money source. You'll probably find someone that's doing business with MCT. And the clients will probably tell you that even if there wasn't a lift in mandatory, if all was equal, you would still want to be mandatory because you're not managing those locks on an individual level. And you're ultimately being able to maximize your execution. But they want to know what the lift is, right? So the difference between best efforts and mandatory is going to be the difference between whatever your lock term is. Maybe you're taking down, let's just say 30-day, 60-day, 45, whatever. So your lock term in your best efforts changes from a long-term lock to a 7-day short-term mandatory lock. So you're locking at funding or like right after funding, and you're delivering those really fast. But if you just look at your spreads on rate sheets, there's so much, there's less rate sheets. Let me turn this down a little bit. There's less rate sheets today on the mandatory side, so you're not going to get a really good view of what the spreads are. They're going to expand and contract over time. We saw them 100, 150, 200 plus basis points last year. That would never be realistic. If you're making the transition, we'd always plan on making about 20, maybe 25 basis points lift over your current profit, and that's net of your hedge costs. So just to keep it simple, just add 20, 25 basis points to your current profit, and I think over time that you won't be disappointed. That's just an easy way. Now, sometimes it's going to be larger. We saw a squeeze earlier this year where it was a little less, but it levels out over time. When you're really maximizing your execution, you're sending it out to the desk, like to Brett, and you're going to see that it's going to be those live bids, the bulk, we're going to call them bulk, right? We're going to see those live loan level bids. That's going to be where you're going to maximize. You're probably not going to commit to a rate sheet execution. So if you're just looking rate sheet to rate best efforts to mandatory rate sheet, it's not going to give you a good indication. Just plan on 20, 25 and you'll be good. Yeah.
Awesome. Thank you. Looks like we've got time for a couple more questions here. Are there any CPA firms that we could recommend to folks on the call, perhaps?
Absolutely. Yes, yes, yes. We would love to recommend CPA firms to you. So get in touch with us after. We would love. I mean, we have partners that we work with. So when we go through our onboarding process, we've got several partners that support that process and offer to be a resource to our clients free of charge, and they're happy to have a conversation with you. We would love to introduce you, depending on what your needs are, where you are in the country. Yes, I'm so happy that you asked that, because yes, we wouldn't want to exclude any partners out there. Even though at MCT, TMS might have a different set, but generally there's a handful of industry accepted ones out there. So we're probably all going to think of the same ones that are really respected. But yeah, we wouldn't want to isolate or exclude, but we definitely would love to get you in our place. Yes.
Awesome. Looks like we're kind of opening up the floodgates here for more questions. So it looks like we've got a few more minutes here. But let's see. So when switching from BE to mandatory, how long is a safe time frame to make the switch over without there being issues or problems?
So from best efforts to mandatory, there's so many factors that go into that. So let's say you really want to have consistent hedgeable volume. So what do we mean about hedgeable volume? We mean that you're hedging your vanilla products. So you're hedging anything that is Fannie, Freddie, fixed rate, your government production fixed rate. So you're not hedging any non-QM, you're not hedging any true jumbo. And we see clients successful at different levels. Everyone's volume is still a little bit up. Usually we say you want to have around 20 million in hedgeable production. Now we have clients that kick it off at 10 million. I mean, if you have a growth trajectory and it makes sense, then you can make that happen. I think the consistency in volume is key because, look, we have clients, again, going back to my original comment, if there was no lift over mandatory, over best efforts, people would still want to hedge. So sometimes clients have the volume and then they've got a division or a branch that leaves and now their volume is 5 million while they're rebuilding and they don't stop hedging because they don't want to go back to the best efforts model where they don't have control. So, but it does become less efficient with smaller volumes. So we would strongly advise that you've got consistent volume and that your lock desk is fully centralized. And you have the right controls in place from a data perspective. We can certainly talk about if you're ready, and we're not, like I said, slow is fast, so we're never rushing people to that outcome. We are huge advocates of taking time, setting it up, and getting ready. But I think volume is one of the biggest key indicators. Having multiple warehouse lines. Yeah, maybe you guys have more to add on that.
Yeah, and just keep in mind when you make the transition to hedging, there's a period of time where you have to aggregate into the hedge. So that really means you're going to stop locking loans best effort while your pipeline moves forward, and when you stop locking BE, you will start placing the hedge for those loans. So however long it takes you to complete the origination process of those loans, 30 days, 45, 60, depending on product and environment, right? That is the period of time before you're even going to be really making your first trade. So it's going to be, that slow is fast process, and just keep in mind that there are certain steps you'll want to take, and you might not be hedging everything on day one. So there's when is the period of time to make my first trade versus the period of time to kind of complete my transition to mandatory, which are two different things.
Awesome. All right. Looks like we want to respect everybody's time. We're kind of brushing up on it right now. For those of you that missed the beginning of the call, we will be sending out the recording and the slide deck. Let's see. Maybe if we've got time for 30 seconds, one more question. How do you protect your margin in mandatory delivery?
Tom, do you want to take that, or do you want me to take it, or Brett? You, Brett?
I can contribute. Okay. I think we talked a lot today about owning your process, controlling your process, and I think having a good handle, Danielle talked about being predictable, right? So having a predictable process, strong controls in your process that creates predictable outcomes for consistency in terms of like pull through on your pipeline and in terms of volume and thoughtfully making changes. The more you can report on, predict your pipeline, the better you can hedge it and protect it. Now, no hedge is perfect, but hedges are designed to be close. Don't make you money, don't lose you money. And if you put good controls in place, you can do a better job of that.
Awesome. Awesome. Well, again, thanks everybody for attending. Thank you again, Danielle, Brett, and Tom. You guys did a fantastic job presenting today. There are more questions than we have time to get to during the call, but rest assured that if you did submit a question, our team will be following up with you to answer any outstanding questions you might have. Again, just as a reminder, we'll be sending out the recording and slide deck after the call. Again, appreciate the time and look forward to chatting with everyone again soon.
Thanks, guys.
Thank you. Bye.
Thanks so much.